Meanwhile, President Cyril Ramaphosa has defended broad-based black economic empowerment policy. He said he has not seen DA's proposals, and if anybody wants an amendment to the BEE legislation, they must table the proposals, and that must be taken for discussion in Parliament. He said the current BEE framework remains a key instrument in addressing past economic imbalances.
Something's happening in the shadows of Johannesburg, quiet, deliberate, and unsettling for those who once held Africa's purse strings. South Africa has just pulled off what few expected. A $500 million funding initiative that has global lenders lining up, not to dictate terms, but to meet them. It's not charity, it's a strategy. Because when Africa's most industrialized nation decides it will no longer borrow on anyone's conditions, the question shifts from how much money was raised to how much power was reclaimed. And that is what's really making the world nervous. But what does this mean for Africa? Let's find out. There are moments in history when power doesn't announce itself. It rearranges the room quietly. What just happened in South Africa is one of those moments. No explosions, no speeches, just a single statement from the National Treasury. And the world suddenly realized something fundamental had shifted in the order of things. The Treasury confirmed it had received over 100 international proposals for its $500 million foreign currency funding initiative. At first glance, it sounds procedural, another government raising capital. But to anyone who understands how global finance works, this was seismic. Because this wasn't a desperate appeal for loans, it was an open audition. South Africa had extended a hand, and instead of creditors tightening their grip, they rushed forward with offers. Behind that calm announcement lies a deeper story. For decades, Africa's financial narratives were written elsewhere, in Washington boardrooms, Parisian ministries, and London trading floors. But this time, the script wasn't printed overseas. It was written in Pretoria. The $500 million target wasn't just a figure. It was a signal that Africa's most industrialized nation is done negotiating from weakness. To understand why this matters, you have to look beyond the number. Because South Africa isn't chasing liquidity, it's testing authority. It's saying to the financial world, we no longer measure progress by what you lend. We measure it by how we decide to borrow. The response was immediate. Over 100 proposals poured in from global lenders, from established investment houses to boutique institutions, from ESG-linked funds to independent financiers seeking a foothold in Africa's next growth chapter. Some came with environmental incentives, others with social impact clauses, but nearly all came with one message. Global investors now see South Africa as a marketplace of stability and innovation, not risk and rescue. That's what caught analysts off guard. The global economy, after all, isn't in a forgiving mood. Interest rates are high, debt markets are tight, and developing nations are facing repayment crises. Yet in that same climate, investors saw opportunity, not danger, in South Africa's offer. Why? Because the Treasury isn't improvising, it's orchestrating. This initiative was designed months in advance, quietly and methodically. Announced in July 2025, it was never about chasing headlines. It was about sending a message to the capital markets that Africa can finance its own vision without crawling through the corridors of the IMF. The decision to target innovative instruments, bilateral term loans, structured notes, and private placements showed that Pretoria wasn't looking for cash, it was looking for control. And that control, subtle as it is, changes everything. Because every lender who participates in this program is operating under South Africa's terms, its laws, its timelines, its framework. For once, the leverage isn't sitting in New York or London, it's sitting in Johannesburg. That's not just symbolic, that's systemic. In the corridors of global finance, credibility is currency. And this move just raised South Africa's credit in a way no bond rating ever could. It proved that investors now believe in the country's fiscal discipline, its industrial potential, and its strategic maturity. They aren't lending out of pity or pressure. They're lending because they trust the process. But make no mistake, this calm confidence didn't come overnight. It's been years in the making, forged in the heat of economic downgrades, power shortages, and social unrest. And that's what makes this funding initiative so unexpected. It rose not from abundance, but from adversity. The real intrigue, however, isn't in how many offers came in. It's in why they came now. What has changed in South Africa's economic posture that made the world suddenly eager to lend where it once hesitated? What is inside this model that makes capital chase the borrower? The answer lies in the structure of this initiative and the quiet rebellion embedded within it. For decades, African economies have been told there is only one respectable way to access global capital: through the Eurobond market or the International Monetary Fund. The formula was predictable: issue a bond in dollars, pay interest in dollars, and live under the shadow of Western credit ratings. These tools were presented as neutral, even benevolent, but in truth they came with invisible strings: policy constraints, structural reforms, and ceilings on how nations could spend their own money. South Africa's new approach doesn't just tweak that formula, it flips it upside down. The Treasury's model invites multiple forms of financing, from bilateral term loans and private placements to structured instruments linked to environmental and social goals. It's no longer a one-size-fits-all borrowing model dictated by global norms. It's a marketplace of ideas, each deal negotiated on equal footing. That's the essence of the rebellion: subtle, intelligent, and almost philosophical. Because this isn't about rejecting Western capital, it's about refusing Western conditions. By designing instruments tied to South Africa's own sustainability goals, the Treasury has ensured that global investors can no longer separate profit from accountability. You want returns? Fine. But your returns must serve our development, not your geopolitics. That's not defiance, that's evolution. The structure itself forces the investor to respect the borrower, and that's what investors found compelling. For the first time, they're not buying exposure to a fragile economy. They're buying into a system that manages risk through design. But there's a deeper layer here. South Africa's economic planners have understood something that most nations still haven't: the power of psychological independence in finance. When a country stops presenting itself as needy, the market stops treating it as vulnerable. This is the genius behind Pretoria's move. It didn't ask for sympathy, it offered strategy. It didn't position itself as a debtor, it positioned itself as a partner in innovation. And that subtle shift in tone, that posture of composure, is what drew so many proposals. Because investors are not just lending to a government anymore, they're investing in an attitude that says, we know what we want, and we'll take it on our terms. South Africa didn't challenge the market by shouting against it. It dismantled the argument beneath it. It exposed the illusion that borrowing must equal submission. By creating a diversified financing mechanism, it revealed the weakness of the old system: dependence. And this is where the true disruption lies. Every Eurobond issue carries the same curse: exposure to a single moment of judgment. One auction, one rate, one perception of risk. But South Africa's multi-channel approach eliminates that vulnerability. If the bond market turns cold, bilateral deals remain. If rates rise, structured ESG instruments balance the risk. The architecture itself is resilient, a web of financing that doesn't collapse when one string breaks. Yet what's even more remarkable is how this move ties back to dignity. For the first time, Africa's largest industrial economy is proving that sovereignty doesn't mean isolation. It means choice. South Africa is engaging with global capital without being consumed by it. It's a controlled opening, not an invitation to exploitation. And that's the subtle brilliance of this entire strategy. It's not about rejecting the world. It's about redefining how the world interacts with Africa. When you control the terms, you control the narrative. When you design the tools, you define the future. But this isn't a solitary act. A financial shift of this scale doesn't stay confined to one country. It spreads, it influences, it inspires imitation. Which raises the next question: what happens when this new financial architecture starts to echo across the rest of the continent? Let's pause for a second to say big thank you to the Black Culture Diary community, where Black voices, stories, and legacies are preserved and amplified. By becoming a member, you're not just supporting the channel, you're becoming part of a powerful cultural movement. Let's continue. When South Africa shifted its financial philosophy, it didn't just draw attention, it created momentum. The world of capital thrives on perception, and perception spreads faster than policy. Within months of Pretoria's announcement, financial analysts from Lagos to Luanda began to notice a subtle pattern emerging across the continent. Something that wasn't visible in spreadsheets, but was undeniable in tone: a change in confidence. Because the truth is, confidence is contagious. When Africa's most industrialized economy stops approaching money like a favor and starts treating it like a negotiation, the psychological landscape of the continent transforms. Suddenly, other governments, once hesitant to explore non-traditional financing, are reconsidering what's possible. The rules that once made borrowing feel like submission now seem negotiable. Take Nigeria, for instance. The West African giant is seeking approval for over $2.3 billion in external loans, coupled with a $500 million sovereign sukuk, a form of financing grounded in ethical principles rather than speculative profit. This isn't mimicry, it's alignment. Nigeria has understood that the era of borrow to survive must give way to borrow to build. Angola, too, is shifting gears. It recently secured $1.75 billion in private capital for refinery projects, not through the conventional multilateral path, but through direct market-based negotiations. The symbolism is unmistakable. Africa is learning to talk to capital directly, without translators. This is how revolutions in finance begin, not with treaties or summits, but with imitation born of success. South Africa's model proved that alternative doesn't mean unstable, and the rest of Africa took notice. Investors who once categorized the entire continent under the single label of emerging risk are now being forced to distinguish, to analyze, to respect. And that's where the real transformation lies. Not just in the flow of money, but in the flow of judgment. For decades, Western institutions built a hierarchy of risk perception. Africa was always high risk, regardless of the data. But when major lenders line up to invest under South Africa's new model, that old hierarchy begins to crumble. It reveals what Africans have known for years. The risk wasn't always economic, it was narrative. Pretoria's success didn't just attract investment, it dismantled a stereotype. It showed that risk is not a property of geography, but of governance. It proved that financial discipline and national sovereignty can coexist, that one doesn't have to surrender to achieve the other. And that revelation has sent ripples across African capitals, where policymakers are quietly drafting their own alternative financing frameworks. In Ghana, economic advisors are studying hybrid financing models that blend state-issued bonds with ESG-linked incentives. In Kenya, there's growing discussion around green infrastructure bonds that bypass traditional Western intermediaries. Even smaller economies like Namibia and Botswana are exploring partnerships that combine private capital with public accountability, the very logic that South Africa pioneered. The domino effect isn't just financial, it's psychological. Every new success makes the next easier to believe. Investors who once demanded 9% or 10% yields on African debt are beginning to recognize the continent's evolving maturity. Slowly, a new equilibrium is forming, one that replaces dependence with diversification. But here's where the narrative deepens. South Africa's move isn't only changing Africa's image in the eyes of the world, it's also changing how Africa sees itself. The idea that capital markets are tools, not masters, is reshaping how African leaders plan development. For the first time in modern history, financial strategy is being driven not by scarcity, but by vision. And this vision is spreading in ways that no trade bloc or summit could replicate. It's spreading through ambition, through imitation, through quiet defiance. It's making nations ask once unthinkable questions. What if we didn't need Eurobonds? What if we could design our own instruments? What if Africa could fund Africa? These questions aren't rhetorical anymore, they're practical. And that practicality is shaking the foundations of the global financial order. Because the more Africa experiments, the less it can be controlled. But with this newfound independence comes a harder challenge: sustainability. Can this new financial confidence endure when tested by real-world volatility, currency swings, political transitions, and market corrections? Can Africa protect its autonomy once the spotlight shifts from success to scrutiny? Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on Black culture, history, civilization, and identity. Let's continue now. Momentum is powerful, but without precision, it becomes chaos. The wave South Africa started has now swept across Africa's economic map, inspiring a dozen imitators. But inspiration doesn't automatically translate into impact, because what separates a movement from a miracle is what happens after the applause fades: the execution. That's where South Africa stands now, on the thin edge between ambition and accountability. It has drawn the world's money, reshaped its reputation, and redrafted Africa's image in global finance. But raising capital is not the final victory, it's the opening round. The real battle lies in where that capital flows, who controls it, and how it reshapes the country's economic soul. If South Africa is to sustain this newfound credibility, the Treasury must build an ecosystem that can handle complexity. Multiple instruments, from structured notes to bilateral loans, demand a network of institutions fluent in risk management, reporting, and transparency. Otherwise, diversity can quickly turn into disorder. And this is the quiet danger of innovation. It tempts overconfidence. Pretoria's planners know this. They have seen how countries that once pioneered new models, from Egypt's short-term bond experiments to Ghana's early Eurobond ventures, later collapsed under their own weight when oversight failed to evolve. South Africa cannot afford to make that mistake. Its credibility rests not just on how creatively it borrows, but on how responsibly it deploys. And this is where the conversation deepens, because money, by itself, doesn't change nations, systems do. The $500 million being raised must move through a pipeline of tangible purposes: infrastructure, industrialization, and energy resilience. If it bleeds into bureaucratic salaries, subsidies, or electoral theatrics, the moral victory of this entire model will evaporate. That's the difference between financial independence and financial illusion. The first builds capacity, the second buys time. The most urgent question now facing South Africa's treasury isn't how much was raised, it's how much will multiply. When investment becomes self-sustaining, when the projects it funds start producing hard currency earnings, the country stops being a borrower and becomes a lender in disguise. That is where real sovereignty begins. But that's easier said than done. The rand remains volatile. The global economy is still recovering from inflationary shocks and unpredictable commodity cycles. And South Africa's domestic reality, power shortages, logistical bottlenecks, and inequality, still shadow every financial victory. To rise above those constraints, the Treasury must translate its international credibility into local efficiency. That means prioritizing sectors that build internal resilience, renewable energy, rail logistics, manufacturing, and technology infrastructure. These are not glamorous investments, but they are nation-shaping. Every dollar invested in industrial capacity weakens the continent's dependence on imports. Every successful project funded under this initiative becomes an argument against the old financial order that kept Africa subordinate. South Africa doesn't need to argue its case for financial sovereignty anymore. It just needs to execute it so flawlessly that doubt becomes irrational. That's the only way this movement endures. Because inspiration alone is temporary, systems are permanent. When the Treasury proves that innovative financing can deliver measurable outcomes, growth, jobs, and export capacity, it will do more than validate South Africa's leadership. It will set a precedent for every African economy still trapped in the illusion of dependency. But precision has a price. The more transparent a system becomes, the more accountable it must be. And the more visible success grows, the more it attracts resistance from both inside and outside. Western lenders who once dismissed African autonomy as a fantasy will now study it as competition. Domestically, political factions will test whether this newfound power benefits citizens or elites. So the next phase won't be defined by capital inflows. It will be defined by moral discipline. Whether South Africa can resist the temptation of short-term populism and stay anchored to long-term strategy will decide if this initiative becomes a foundation or a caution. And that brings us to the final, unspoken question. What does this transformation mean for Africa's place in the global hierarchy? If one nation can rewrite the rules of borrowing, can an entire continent rewrite the rules of power? The real story was never about the $500 million. It was about what it represents. Because once a country learns to dictate the terms of its own borrowing, the conversation stops being financial and starts being philosophical. South Africa isn't just diversifying its funding sources, it's redefining what economic power looks like in the 21st century. And that's precisely what makes this moment so disruptive. For generations, Africa's relationship with money has been defined by dependency, the kind that masquerades as partnership but always favors the lender. Nations would borrow not for growth, but for survival, and in the process, surrender control over their own priorities. Budgets were balanced by external approval, not internal conviction. Development became a function of permission. But with this initiative, South Africa has drawn a line in the sand, a quiet declaration that the age of dependency is over. By structuring deals that align with its national goals rather than external agendas, Pretoria is asserting that Africa's growth must now serve African logic. That single shift in perspective, from compliance to authorship, is the birth of what might be called economic sovereignty 2.0. Independence, not of isolation, but of intelligence. Because sovereignty today isn't about closing borders or rejecting foreign investment. It's about controlling context. It's the ability to decide which partnerships amplify your strength and which dilute it. That's what South Africa has done. It has taken the global financial system, a system once built to discipline the developing world, and used its own complexity as leverage. The deeper meaning here is psychological. When a nation that was once shaped by colonial economics begins to master modern finance, it doesn't just accumulate wealth, it accumulates narrative power. For decades, Western analysts measured Africa in deficits: a deficit of trust, a deficit of capacity, a deficit of governance. But now, those same institutions are competing to fund the very governments they once lectured. That reversal is not coincidental. It's evidence of a paradigm quietly collapsing. And if South Africa executes this model with consistency, it won't just redefine its own reputation. It will alter how Africa interacts with global markets entirely. Investors will no longer look at the continent as a risk zone. They'll look at it as a negotiation table, a place where deals aren't dictated, but designed, where growth isn't conditional, but mutual. This new African financial philosophy, patient, strategic, and self-assured, represents a kind of power the world isn't accustomed to. It doesn't roar, it recalibrates. It doesn't protest, it performs. It wins not by confrontation, but by competence. And that is precisely why it unsettles the old order. Because power built on dependency thrives on chaos. Power built on discipline creates clarity. And clarity is dangerous. It exposes imbalance. When Africa begins to manage its capital with foresight, the illusion that it needs external supervision collapses. Western institutions lose their moral monopoly. The IMF's guidance loses its mystique. Africa ceases to be a project. It becomes a participant. And therein lies the greater consequence. Once the continent's largest economies learn to master financing on their own terms, they start speaking to each other differently too. The conversation shifts from crisis management to collective design, regional trade, cross-border credit lines, and joint development funds. The Pan-African vision, long dismissed as romantic idealism, suddenly finds its financial infrastructure. This is where South Africa's move becomes more than national policy. It becomes continental precedent. It's the prototype for what a post-dependency Africa could look like. A continent that doesn't wait for permission, doesn't justify its ambition, and doesn't measure progress by approval ratings from abroad. But make no mistake, this power comes with responsibility. The more Africa proves capable of managing its finances independently, the more the world will hold it to higher standards. Transparency, ethics, and governance will no longer be optional. Because once you declare yourself sovereign, excuses expire. Yet that's exactly the maturity this moment demands, a self-correcting Africa, capable of balancing power with prudence. And South Africa, whether it intended to or not, has just become the first true test case. If it succeeds, the door opens for an entire continent. If it falters, the cynics will return, and they will say Africa was never ready. But perhaps this time, the cynics will be wrong. Because what's unfolding now is not a financial experiment, it's a philosophical awakening. It's Africa proving that sovereignty is not a slogan, it's a system. And when a system starts working, quietly, efficiently, and on its own terms, that's when empires begin to listen. The $500 million may fund projects and pay contractors, but its real value lies elsewhere, in the signal it sends. That Africa is no longer asking what it's worth, it's declaring it. What happens when Africa no longer borrows to survive, but to dominate? Let us know in the comments section. If control of money defines power, who really controls it now? Do you want to watch more videos like this one? If so, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: the Black culture, civilization, history, and evidence about how glorious Blacks have been. Thanks for watching, and until the next video, stay tuned.